What's up traders, it's XViper TV and welcome back to the channel. Have you ever felt completely lost about where the market was heading? One moment it looks bullish, the next it feels bearish, and you end up taking trades that go against the real flow. That's not random. That's a lack of understanding market sentiment. In the last video, we broke down how to place stop losses using order flow and price action so you don't get shaken out. But knowing where to place your stop is only part of the game. To really trade like a pro, you need to know overall market sentiment. Who's in control, buyers or sellers, and where the market is trying to go. So that's what we're going to cover today. How to read market sentiment like a pro by identifying highs, lows, and swings. Now let's get into it. Now before we get started, this video is for educational purposes only. I'm not a financial advisor, and you should definitely trade at your own risk. Now what does market sentiment truly mean? Market sentiment isn't just about news or headlines. It's the collective psychology of buyers and sellers. When sentiment is bullish, price is making higher highs and higher lows. When sentiment is bearish, price is making lower highs and lower lows. When sentiment is neutral, price is stuck in ranges or consolidation. Your job as a trader is to read the sentiment directly from the chart. No guessing, no feelings, just what price is showing you. Now let's start simple, highs and lows. A swing high is a peak where price rallies up and then turns back down. A swing low is a valley where price sells off and then turns back up. These swings tell you who's in control. If every new swing high is higher than the last, bulls are driving sentiment. If every swing low is lower, bears are in control. Example, here's a chart where price makes a high, pulls back, and then pushes to an even higher high. That's bullish sentiment. On the flip side, when each rally fails to reach the previous high, sentiment is weakened and often flipping bearish. Now here's an example of a chart where price makes a low, pulls back, and then pushes to an even lower low. That's bearish sentiment. Now, if price fails to make a lower low than the previous low, then sentiment is weakened and often flipping bullish. Here's the key rule. If price breaks below the low that created the most recent high, that's a change in sentiment to bearish. If price breaks above the high that created the most recent low, that's a change in sentiment to bullish. These shifts are critical because they show when the market is no longer trending in the same direction. Example, let's say the market is making higher highs and higher lows. Then, instead of holding, it breaks below the last higher low. That's your first clue buyers are losing control. That's how pros spot reversals early. Now here's where most traders get tripped up. You might see bullish swings on the 5-minute chart. But if the higher time frame, like the 1 hour or daily, is clearly bearish, those bullish swings are just pullbacks inside a bigger downtrend. That's why pros always establish a higher time frame bias first. If the daily is making lower highs and lower lows, your bias is bearish. If the daily is making higher highs and higher lows, your bias is bullish. Then you drop down to a lower time frame to fine-tune entries, but you're aligning with the bigger picture. This keeps you trading with the tide instead of fighting against it. Not every market is trending. Sometimes sentiment is balanced. Buyers and sellers are both active, creating consolidation. In these conditions, highs and lows are respected back and forth. Sentiment isn't bullish or bearish. It's neutral. A pro trader doesn't force trades and chop. They wait for a break in sentiment when price breaks out of the range and creates new structure, showing which side won the battle. Now let's put it all together. Here's the big picture. Bullish sentiment, higher highs and higher lows. Bearish sentiment, lower highs and lower lows. Neutral sentiment is ranges and consolidation. Sentiment shifts, break of key swing highs, lows that created a last move, and higher time frame bias. Keeps you aligned with the real trend while filtering out lower time frame noise. By reading these clues, you stop guessing and start trading with the flow instead of against it. In the next video, we're starting a brand new series, breaking down popular indicators to see if they actually work in today's market. The first one we'll cover is the moving average, and we'll answer the big question, do moving averages work in today's market? So if you found this video helpful, smash that like button and subscribe so you don't miss the next one. This is XViper TV. Thanks for watching and happy trading.